Good morning, everyone. Thanks so much for joining me. Today, we're going to talk about common covenants or terms that you would see on a term sheet from an investor. I'm going to go over what a term sheet is and some of the common things that you would see on that you need to think about, because it's not just about getting money from an investor. There are always caveats and conditions that come with that money. So it's something I want you to think about. Back in 2001, I lived in Japan for a while. I was teaching English, I was training martial arts. Really beautiful country, great place to visit. Wasn't really where I wanted to live long term, so I came back to my girlfriend, now wife, and decided to be with her. But I spent a fair amount of time there, and it's a lovely place. But when you're in Japan and other countries, you learn their mannerisms and their culture and differences. And one of the things I learned about Japan in that process is that in meetings with executives and other people in general, that the Japanese tend to nod a lot, and they will say yes, 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 quite a bit. And what I learned is that by doing that, they are not agreeing with what you're saying. They are simply acknowledging what you are saying. And I thought about that as I was writing this article as it relates to meeting with investors. I've heard plenty of stories, startup founders who have gone on to, meet with investors, and those investors fall in one of two camps. Those investors will be really explicit about why they are not interested in your business, or they may say something like, it's just too early, that kind of thing. Or they will not be honest about how they feel about the opportunity, and they'll just kind of brush you off by saying, let's stay in touch. I'd like to see what happens in the next 6 months, those kinds of things. So one of two camps. They're either really honest about why they're not going to invest at the time, and they give you great feedback. Those are the type of investors you want to get rejected from. Or sometimes they'll just not be entirely honest about how they feel, and they're not direct enough, and it kind of leaves you wondering how things went. And so this idea of yes, yes doesn't mean that an investor is agreeing with you. If they're saying yes to the things you're talking about, or they think it's a good idea, that still doesn't mean that they're going to invest in it. Remember, investors are having so many opportunities that they get to pick the ones that they want to work with. So even if they love what you're doing and they're saying yes a whole bunch, that doesn't necessarily mean that they're going to invest in your startup. So what is a term sheet? Well, I'm going to tell you a story here. It's a little bit like what you get when you get a business loan. So as a former chief lending officer, when we would work with borrowers who are wanting to borrow money for their business, you actually get two types of documents typically from a lender. And I'm going to relate that to the differences with an investor term sheet. So the first document you will get from a lender is called a term sheet. What is that? Well, it's really just an outline of what the deal might look like when you get that from a lender. Note the key word there, might. Doesn't mean it's entirely agreed upon. So what they will do is they will do a sort of a small, quick pre-approval and then give you a term sheet that says this is how long the loan will be for, this is what the rate is going to be, these are the other conditions that are going to come with it. That is similar to how an investor term sheet works. An investor term sheet is really just an investor giving you a document that says, assuming everything else comes together, the rest of the due diligence works the way we want, this is how you should expect the deal to look. So that's really, really, really important for you to think about. And I'm going to put a link to an article that was written that did a nice job of detailing some of the pieces of a term sheet in the description of this video. And if you'll just scroll to the bottom of that link, you'll start to see exactly what a term sheet might look like. So a term sheet is basically them just saying, here's our terms, right? Here's the terms under which we will invest in your startup, and it includes quite a few things. So what is covered in a term sheet? Well, some of the things that you could imagine, right? So defining the amount of the investment. So if they are willing to give you $500,000, it's going to say, $500,000. The term sheet will also establish the valuation of the business at the time. So it will say $500,000 current, valuation post funding round, 2 million, something like that, right? So it will lay out the amount of the investment and the valuation that they have determined. And why is that important? That is used in subsequent fundraising rounds for other investors to think about what the new valuation of the business will be. Assuming you've accomplished a lot of good things, that valuation should be driven up. There are things called down rounds, which means that the valuation is lower than the previous round, and that's in a direction you don't want to travel. Some other things that would be on a term sheet: what type of shares the investor is getting in return for the equity. So with a lender, you're paying them payments, and that's how they get paid back. Investors get paid back by owning shares of your company and then you having some sort of exit. And so in a term sheet, they are laying out what type of shares they are getting. Are they getting preferred shares? Are they getting common shares? Those types of things. Then you will start to see some of the more explicit conditions of the term sheet. So they've laid out amount, valuation, what type of shares they're going to get, those types of things. Now you will start to see potentially some additional conditions or covenants as part of their investment. So one of those could be a liquidation preference, which just in short means if a sale of all or some of the assets of the business occurs, that the investor or investors with liquidation preferences, that means that their shares or their assets get sold first, meaning they recoup money before everybody else. So there's this pecking order in which people get paid back when there are liquidation preferences involved. You may see an investor include a covenant that they're entitled to some dividend payments. Maybe the company's having some excess cash and they're sort of claiming that they deserve to get paid some dividend payments. You will also see some conversion rights, which means, if the investor has one type of shares versus another, they can convert those shares. Typically, it's if they have preferred shares. If an exit occurs or some sort of merger, they can convert those shares into common stock. You also see, and this one's quite common with the startups I've worked with, how many, if any, seats on the board of directors that the investor gets. So this is where it's different than a loan. If you get a loan, the bank doesn't sit on your board of directors and have a vote in what happens with your business. With investors, they do. And so not all investors ask for this, but especially in later rounds of funding, the investors typically get seats on the board of directors. That gives them even deeper insight into what's happening with the business. And it also gives them some power over the startup itself with their votes, with the shares they have. And then another thing you might see is establishing what's called vesting schedules. So this is establishing the period of time over which the founders and key employees earn their shares. So if a key employee is being hired, maybe you're hiring a chief marketing officer and that key employee is being hired, and they are being given some equity as part of coming on board, call it a 1%. They don't always get those shares the day they start. They are vested over time and they're able to earn those. So maybe they earn those over a 5-year period. That encourages that chief marketing officer to stick around in order to earn that 1% along the way. So there's lots of sections to a term sheet. It doesn't just have the standard things. There's other things like option pools for early team members and advisors. And we talked about conversion rights and those types of things. And then another thing you can see in a term sheet could be addressing how super voting rights are handled. So lots of things to think about. And so my point with this is, it's very exciting when you get a term sheet, but do not just, kind of sign on the dotted line. Spend the money, hire a qualified attorney who understands these types of transactions, not someone who's just a general business attorney, has never done this type of deal before, and have them review the term sheet. Make sure you're not missing something that's going to be too restrictive or something that you just don't have the appetite for. And then lastly, what I want to say is, again, a term sheet's very exciting. It means you have the potential to have an investor on your team or investors, but can you negotiate a term sheet? Absolutely. Now, the best time to negotiate a term sheet is when you have multiple term sheets sitting on your desk. So if you just have one offer from one investor, it's going to be a lot harder to negotiate. It's kind of like offers on a piece of real estate. If only one group or one couple has put an offer on your home, it's harder, doesn't mean you can't, but it's harder to negotiate. If there are 4, 5, 6 offers on your home, it becomes a lot easier to go back to some of those and say, you're kind of low. You're going to have to come up if you want to participate. And this can happen with your term sheet that you get from investors as well. So keep that in mind. You can negotiate it. Make sure you're checking out these various sections. Some of these things can be very restrictive or hurt you in the future as the founder of your startup. It's great to get an investment, but you want to do it when it is a win-win for both parties. Anyways, thanks for joining me. Till next time, hope you find your voice. Have a great day.